Hi everybody, Lance Brownie, Income Solutions, Wealth Management, and Chandler Wealth Solutions. Happy second half of 2019. Happy summer to you. That can only mean one thing. Time for the halftime report. It's always tough to make predictions. Quote the great philosopher Yogi Berra, it's tough to make predictions, especially about the future, but we're sure going to try. And let's talk about what could go right. Trade agreements could get finalized and in motion, especially between the U.S. and China. You could have no black swan geopolitical or terror events. The Fed could stop hiking interest rates. I think we can put a checkbox by that one. The economy keeps growing at 3+% a year. That's pretty good. Unemployment stays below 4%. And inflation pressures remain under control. Also, what could go wrong? Well, Washington, D.C., in short, you know the old saying about politics, right? If you're not at the table, you're on the menu. So Washington, D.C. could very well mess a lot of things up for us. You could see more trade tensions, and not just with China, and no trade deals. The Fed. They could certainly miss their landing spot on the soft landing, and we could get a more of a bumpy landing from the Fed. Global growth, or lack thereof, could spill over into the U.S. But really and truly, it's all pretty much about the Fed and about China. So this is a chart. We showed you this last year, showing when interest rates rose, how much, how long, and then the ultimate effect on the market and on the global economy. So looking at this as of last year, the average market drop during a rate increasing cycle when the Fed was raising rates was 20.15%. Sure enough, and that market declined in the fourth quarter of last year of 2018 after 4 Fed rate hikes in 2018. The stock market dropped from the end of September until right before Christmas exactly 20%. That's exactly the average drop in the market for an average rate hiking cycle. I love this one. It's called the Fed game. I think they actually do this. I think Jay Powell and the Fed actually have one of these little twister things there at the Fed. I think they use it regularly. So is it time to worry? Well, what an inverted yield curve does and doesn't mean, and this was a headline from back in March. So this is something we haven't talked about in a while. What is called an inverted yield curve. What exactly is an inverted yield curve? Well, an inverted curve is when the short interest rates are higher than longer-term interest rates. The reason we care about yield curve inversions is that yield curve inversions have preceded each and every recession since 1970. Think of it this way. You can have a bad storm and have a funnel cloud without actually having a tornado hit the ground. But you can't have a tornado without having that bad storm or that funnel cloud first. So that inverted yield curve is sort of like our funnel cloud. It's our warning. When investors get nervous, they buy treasury bonds, the 10-year treasury bond in particular. This buying on the part of investors or other central banks when they're doing quantitative easing causes the price of those 10-year bonds, those treasuries, to go up, and the yield on the 10-year treasury bonds to go down. Note that the market typically controls longer-term interest rates. When the Fed gets nervous, and the Fed typically controls shorter-term interest rates, when the Fed gets nervous, it typically raises short-term interest rates to fight off inflation. This is a very unnatural and abnormal state. It's generally a bad thing when investors are not rewarded for taking longer-term risks. Think about it. Why would somebody invest money for 10 years when they could get a higher rate of return by investing for 3 months? Inverted yield curves are concerning. So this slide shows the last 7, and not counting the current, inverted yield curves going back to about 1968. So 50 plus years of data. It shows the date that the inversion happened when short-term interest rates became higher than long-term interest rates, and how long it took for a recession to take hold. You can see at the bottom that the average time for a recession to happen after an inverted yield curve is about 14 months, just a little over a year. Hopefully history doesn't repeat itself, or if it does, it takes a while. Well, perhaps true to his nature, or perhaps seeing what happened to Bush 41 in 1991-1992, President Trump has been very vocal in his calls for the Fed to not only stop raising interest rates, but to actually cut interest rates and begin more quantitative easing stimulus. This is a big, big change, and this is a headline from April 30th of this year. Sure enough, the market seems to have taken all of this rate cut talk to heart. So much so that I've seen recent data showing a 90% chance of an interest rate cut being priced in the Fed futures market. The Fed futures believe this will happen as soon as the July Federal Reserve meeting. Personally, I'm afraid that the Fed funds futures that the market may be a little bit disappointed. I believe that it may be very hard for the Fed to actually cut interest rates with the economy growing above 3% and unemployment below 4%. We shall see. Another funny, no, I'm not a unicorn. I'm the Fed's economic forecast. We'll say that's close enough. So Fed forecasts and unicorns, we see them simultaneously. Keeping with our boxing theme here, so in this corner, the United States. In this corner, the People's Republic of China. Let's talk about our trade war and the conflict that's going on right now. So aside from the Fed's actions, which are important, we believe that the market will be greatly influenced over the next 6 to 12 months by what happens in our trade war with China. Both the U.S. and China seem to have come out swinging. Many in the U.S. have long been concerned about our free trade agreements with other countries, China in particular. None are more concerned about these agreements than the Trump administration. President Trump has recently begun initiating tariffs or taxes on goods imported from other countries like China. In some cases, these tariffs can run up to 25%. So let's stick with that 25% number for just a second. So this 25% tariff has made the break even, about 25%. So if manufacturing is moved to somewhere else besides China, it will need to be less than 25% more expensive than China to make it economically feasible. So for example, let's say it costs a U.S. manufacturer $80 a unit to manufacture an item in China. With a 25% tariff imposed by the Trump administration, it would have to cost 25% more for that same manufacturer to have that same item made somewhere else in the world. Basically, if we add 25% to an $80 Chinese unit cost, it would have to cost about $100 to make that same item somewhere else. That $100 unit cost is now our break even. And this is probably doable, but it's just not doable quickly. Things like logistics, labor, training, infrastructure, other trade-related issues would have to be worked out ahead of time in order for this seismic shift in global manufacturing to happen. America would like to continue to make stuff cheaply in China, of course. The question is, at what cost? If you're China, it's also good news, bad news. So the good news is they can play the quote-unquote long game for a little while in this conflict. They don't really have Western-style democratic elections in China. So if the Chinese people don't like their government or its policies, tough. Not much the average citizen can do about it. One tool the Chinese government may use is to simply outlast the Trump administration through the 2020 election. Any harm to the U.S. economy will essentially be borne by the president at the ballot box, up to and including him only getting one term. And the U.S. owes China a lot of money. The Chinese hold a tremendous amount of U.S. government debt. Which brings me to the bad news for China. While the U.S. may want cheap Chinese manufacturing, the Chinese absolutely must have the American consumer. Europe is struggling as a whole. Japan's economy isn't doing that well, hasn't been, and there are centuries-old conflicts between Japan and China. In short, really the only sizable economies in the world that are growing, pretty much United States and China. To keep the machine running in China, their government and their economy are fueled largely by that same U.S. consumer. So to briefly go into how this works, let's kind of use a simple example here. So China manufactures a good and they ship it to the United States. We, Americans, we buy that manufactured good. We send our dollars back over to China. China then, quote unquote, recycles those dollars by buying U.S. government debt, sending those same dollars back to the United States in exchange for government debt or an IOU from the U.S. Treasury. The U.S. consumer takes those recycled dollars, buys more Chinese goods, and so the trade cycle continues. The question for now is, how long? And what will this look like over time? To quote another great philosopher, Clubber Lang, Mr. T, my prediction, pain. In the short run, this is causing pain for both the U.S. and China. So China's not selling as many goods in the U.S. due to tariffs. Costs in China, especially for food, are going much higher. This puts a tremendous strain on the average Chinese worker. Those few fortunate U.S. businesses that are selling products in China are seeing retaliatory tariffs of their own from China. This means they are selling fewer goods and products in China. This has hit the U.S. farmers especially hard. Thankfully, we believe this trade war may be fairly short in duration. In the days of the Cold War, if you'll remember, neither the United States nor the Soviet Union would attack each other, knowing that such an attack would cause what we called mutually assured destruction. No one would survive. In essence, the trade war with China is very similar. Both sides, and this does include China, really need a workable trade deal done. Oh yeah, the markets. By the way, the markets. We'll close by looking at a couple of slides here where showing where we are in the market and whether or not we're at high or low valuations currently. The first we're going to show is what's called a PE ratio, price earnings ratio. Basically, how many dollars in price do we as investors have to pay for every dollar of earnings the companies in the market make, every dollar of their profits? Another word for every dollar of their profits and how many dollars we do have to pay for in stock price. Normally, this number is between $16 and $17. We pay $16 to $17 in stock price for every dollar of profits these companies earn for themselves. 16 to 17 is the norm. We're currently a little north of $30. This is almost double what it historically normally is. We are still about the second most expensive this market has ever been, according to Shiller's PE ratio. This is another one of our favorite indicators known as the Buffett indicator. And to be clear, we're talking about Warren Buffett, not Jimmy Buffett, okay? So Jimmy Buffett would obviously measure things a little differently than Warren would, and we'll leave that up to your own discretion as to which one you want to follow. The Warren Buffett indicator here looks at how big the U.S. stock market is and how that size compares to the size of the total U.S. economy. As of June 2019, the Buffett indicator is about 124.6%. In other words, the U.S. stock market is worth 124% of what the entire U.S. economy is worth. While this isn't the highest reading we've seen in this particular cycle, this measurement still is roughly the second highest reading ever, behind the tech bubble of the late 90s. Again, this shows some pretty lofty valuations for the U.S. stock market. In closing, we'll look at one last measurement we often use, known as margin debt. Margin debt. Basically, how much borrowed money is fueling the stock market. The blue line is stock market growth. The red line is margin debt or borrowed money in the stock market. As you can see, we are still very, very high. While not at the high for this cycle, we are still at the highest reading ever for borrowed money in the market. Certainly bears watching. A few words from our lawyers. I want to thank you again for joining us against Lance Browning with Income Solutions Wealth Management and Chandler Wealth Solutions. Have a blessed rest of 2019.